Modern corporate treasury programs face a structural dilemma. They must protect their balance sheet with safe assets, but they also require immediate operational liquidity to run their business. Keeping large fiat reserves in traditional commercial bank accounts satisfies the liquidity requirement, but it incurs cash drag. Those accounts frequently yield as little as 0.5%. In an environment with elevated interest rates, that yield deficit erodes the company's purchasing power. This comparison model illustrates the traditional workaround and its structural limitation. Treasurers allocate excess cash to U.S. Treasury bills or commercial paper, but the capital is blocked by a T+1 or T+2 settlement cycle. Those settlement delays are compounded by legacy banking cutoffs and weakened illiquidity. Capital gets trapped during critical market hours when volatility might demand immediate deployment. Tokenized real-world assets, or RWAs, successfully bypass these legacy constraints by entirely digitizing the ownership of the physical asset. Wrapping sovereign debt inside modern blockchain infrastructure allows an institution to decouple an asset's credit profile from its operational velocity. By bridging this mechanical gap, corporate treasuries no longer have to choose between earning sovereign-grade yield and maintaining 24/7 atomic liquidity. To understand how this works, we have to correct a common professional misconception. Tokenized is not a new asset class, and it does not introduce new credit risks. The underlying asset in these funds is still a standard sovereign-backed U.S. Treasury bill. This architecture begins off-chain, with physical Treasury bills in traditional custody. A bankruptcy remote special purpose vehicle legally isolates these assets. A permissioned smart contract then restricts access to verified wallets. Finally, decentralized oracles provide continuous proof of reserve, matching off-chain assets to on-chain tokens. In the issuance pipeline, fiat is wired, the issuer purchases the T-bills, and cryptographic tokens are minted one-to-one to represent legal ownership. This blockchain stack replaces the traditional transfer agent and clearinghouse, removing intermediated brokerage layers. Tokenization rewires the operating mechanics and settlement speed of the asset without altering the underlying sovereign risk profile. Once the asset is on-chain, issuers must choose how to calculate and distribute the yield. This creates a divergence in the token's mathematical model. Choosing the wrong structural math can create significant tax and accounting friction for a corporate controller. This split ledger compares two models. Left is the rebasing token. Net asset value stays at $1, while new tokens are minted daily, creating continuous taxable events under U.S. GAAP. Right is value accruing. Supply remains fixed, but token price steadily appreciates with accrued interest. This provides a corporate tax advantage. The accrued interest is treated as a single capital gain event, realized only upon final redemption. The operational trade-off is that these tokens require sophisticated NAV-aware pricing oracles to be read accurately by decentralized protocols. Conversely, rebasing tokens feature a stable price, but their shifting wallet balances frequently break the internal accounting ledgers of automated exchange risk engines. A CFO must choose their token infrastructure based strictly on whether their primary objective is DeFi composability or standard tax ledger simplicity. The challenge is integrating these value-accruing RWA tokens into automated financial infrastructure. Early yield-generating protocols required bespoke, custom-audited integration adapters for every new strategy. The solution is the ERC 4626 Tokenized Vault Standard. This standard unifies deposit, withdrawal, and yield calculation interfaces into a single, predictable framework. This architectural standardization removes the need for manual reconciliation and custom coding. Corporate treasuries can now deploy capital into these vaults to automate yield streaming and portfolio rebalancing instantly. The ERC 4626 standard shifts isolated RWA tokens from passive holdings into programmable, interoperable building blocks for corporate finance. The highest level application of yield architecture involves deploying RWAs as collateral within derivative markets. Traditional quantitative trading models rely on stagnant, non-yielding fiat stablecoins to margin perpetual futures contracts. This causes capital erosion during volatility, where trading desks bleed capital to continuous negative funding rates. This risk engine schematic shows a new mechanic, depositing a wrapped, value-accruing treasury token into an exchange's margin engine instead of fiat. The collateral immediately generates a continuous 5% fixed income baseline from sovereign debt, while simultaneously earning the derivative funding rate. This creates a mathematical buffer. The baseline Treasury yield directly subsidizes the cost of execution slippage and negative funding rates. By stacking traditional fixed income yield beneath decentralized derivative yield, institutions optimize the Sharpe ratio and profitability baseline of complex trading models. We must now pivot from capital optimization to the specific risk vectors introduced by tokenization. Because the underlying asset is U.S. government debt, traditional sovereign default is not the primary threat. The actual vulnerabilities are mechanical: smart contract exploits, Oracle data latency, and regulatory freezes at the off-chain custodian. A secure CFO workflow starts with a legal memo to verify the bankruptcy remoteness of the SPV. The second step is formalizing the GAAP accounting classification and tax reporting profile to match the specific token mechanics chosen. The final requirement is a failure dry run to stress test redemption conversion during weekend illiquidity or simulated key compromise. Decentralized financial engineering has turned cash drag into a programmable, yielding asset, but only for institutions rigorous enough to underwrite the shift from credit risk to infrastructure risk.